Germany's EEG 2027 draft may be the most significant shift in how the country supports renewable energy in decades. For years, the German government has supported renewable energy throughout a simple guarantee, a guaranteed price for electricity known as the strike price or anzulegender Wert. If average capture prices fell below it, the state paid operators the difference, protecting them from losses. When electricity prices spiked, however, asset owners kept all the extra profits. It was a one-way guarantee. It became expensive for the state and didn't align with how modern electricity markets operate. The EU has now mandated a change. All new renewable energy project support across Europe must now use two-way contracts for difference, a more balanced model. So what might this mean for renewable energy projects that have historically relied on subsidies? Under the new EEG 2027 rules, when prices are low, the state still pays operators the difference. Projects remain financially secure. When prices are high, however, operators must pay back excess revenues to the state. This is called the Refinanzierungsbeitrag, the clawback mechanism. What's important is that the system is planned to be based on annual settlements as before, not quarter-hourly real-time adjustments, so the so-called safety light. This is where batteries become critical, especially because the additional subsidy bonus from co-location cases under the innovation tender has now been eliminated in the new system. With a battery, you can sell power during the highest price hours of the day. Since the clawback is calculated on an annual average, you keep the difference between your peak sales price and the government average, your trading margins. This way, the battery lets you beat the safety average and acts as a financial hedge against the state scheming your profits. Let's say the government's calculated annual average is 60 euros per megawatt hour, but you are selling from your battery at 130 euros per megawatt hour during evening peak hours. The clawback applies to the average, not every transaction, same as previously in the market premium EEG. So you will keep those margins, the difference between your 130 spot sales and the 60 government average, which is 70 euros per megawatt hour. With Gridcog, we built a project to compare these two support models. Our baseline scenario is a co-located solar installation with a green battery under the old EEG market premium scheme of 45 euros per megawatt hour. Then we asked, what if the safety model were already implemented in 2025? We modeled multiple scenarios with different strike prices for the safety contract. In scenario 2, it's 45 euros per megawatt hour, and scenario 3, it's 20 euros per megawatt hour. Finally, in scenario 4, we showed how much upside you can achieve with the safety contract when the battery is configured as gray under Mischwell regulation. Check out our video on this topic for more detail. When we open the results, we can see that in scenarios 2 to 3, the scenarios with safety strike prices of 45 and 20 euros per megawatt hour, the revenues are significantly lower compared to scenario 1, which is our market premium EEG green battery scenario. This is because 2025 was the year when clawback payment needed to be made, meaning that the market value of solar that year was higher than the strike price of 45 euros per megawatt hour. The CET scheme with the same strike price might deliver much lower revenues. However, as soon as the Mischwell comes in, we have a better business case than in the old EEG scheme, as you can see in scenario 4. With Mischwell, you can earn more from the wholesale market and additionally receive back the non-commodity charges. Germany's renewable energy landscape is changing a lot. Developers and investors need to keep up with the changing environment. If you'd like to assess your project potential profitability with the new CFD scheme, reach out to the Gridcog team.